Now it's time to have some fun with private equity valuation. This is probably the reading you've been looking for. So anyway, let's think about what happens with private equity and where value comes from. So I think that we can interpret this primarily in the context of an LBO firm. We're going to spend a fair amount of time with venture capital. So the way the curriculum divides out private equity is to LBO and VC. But I think if you think of this or conceptualize it in terms of the private equity, I think in terms of LBO, I think this is easier. So what are we going to do? Where are we going to create value? Well, we're going to re-engineer the firm. That is, we have a firm that has products in the marketplace, a customer base, brick and mortar, all that sort of stuff. But for whatever reason, it's underperforming. If it wasn't, it wouldn't be a private equity target. And we want to re-engineer it, get rid of some middle management, tune up the quality control, ramp up R&D, whatever it happens to be. But in some way or another, we're going to be able to come in and make operations more efficient. Then we may be able to bring to bear more capital market presence and get lower cost financing. So if you've got access to cheaper credit because of whatever expertise, reputation, and resources the fund brings to the table, well, having lower cost debt, of course, is going to increase value as well. And then we're going to have better goal alignment between management and the private equity firm. So the private equity firm, when they take the firm private, is going to bring in a management team in all likelihood, and that management team is going to have their incentives well aligned with the private equity investors, because the management team will get enough to keep body and soul together in the interim, but their primary payoff is going to be when at the exit of the private equity firm itself. So everybody is looking for, let's build the value of the firm, let's get it to where we can find a profitable exit, and we'll all do well under those circumstances. So management's able to focus on long-term performance instead of short-term performance. There's this note that publicly traded firms have to focus on the next quarterly earnings statement, whereas for private equity, maybe they can look out a few years. There's a number of mechanisms in place that we can use to align the interest of the private equity firm and the portfolio company managers. And that's going to show up in the term sheet about when people get paid off. And basically, we're going to structure it so the management team does well when the private equity fund does well as well. So compensation is going to be linked to performance, and this tag-along clause just means that management's going to exit with the fund and everybody's going to be rich. So what about on the venture capital side? So valuation characteristics of venture capital. Well, the important thing to remember is that the dichotomy is rather sharp. On the one side, we have LBO firms, lots of brick and mortar, they've got established customer base, products in place, all that sort of thing. On the VC side, we're investing in a firm that's basically working out of some dude's garage somewhere. And so it's going to be, maybe have never had any revenues. And it's going to be something where, thinking about cash flows, well, there are no cash flows, or they're certainly unpredictable. The product itself is going to have, an uncertain future. It doesn't have any existing customer base, or certainly not wide customer acceptance. It may not have any, brick and mortar or collateralizable assets. So they're going to have an idea, maybe a beta product, those types of things. The management team is, hopefully is going to have a strong entrepreneurial record. This is the managerial team for the fund. There's not going to be much leverage involved. Nobody wants to loan money to a really small firm. If they do well, you get your 7%. If they don't do well, you get minus 100%. Doesn't sound like a very good trade-off. So it's going to be primarily an equity investment environment. And of course, the risks here, there's going to be lots of risks. Okay? But measuring, quantifying those risks and determining where they're coming from is going to be difficult. So exit strategy is going to be unpredictable. Of course, the grand poobah of exit strategies is to take the firm public. So what you'd like to do is buy into the firm today, spend a few $1 million, and then when it goes IPO 5 or 7 years later, you take home a check for $2 billion. That's a pretty good investment. So in terms of operations for the VC firm, they're going to have this high cash burn rate, right? So they're bringing to bear some sort of new idea, right? Bringing this to market. There's going to be problems along the way, lots of learning that has to occur. So this is going to be a cash-hungry organization. That's why they bring in the private equity firm to begin with. That's why the VC firm does. They provide this cash, and hopefully that idea eventually grows into something that is going to have, be scalable and have great market presence and those types of things. So there's going to be, but while they're doing this, there's going to be a lot of capital required to get the product from where it is today until to the point where it's ready for a secondary market sale or an IPO or something like that. Typically, the returns on a VC fund are going to be based on the performance of a few of the investments. So if you think of maybe a VC fund investing in 10 different companies, 2 to 5 of those are going to, we're going to put some millions of dollars in on the front end, and then the back end is going to be, we're going to have a sale in the parking lot where we sell off some chairs and some fake plants and a few desks or something. In other words, it's going to be something close to minus 100% return. We're going to have some number, 2, 3, 4 that are going to be, well, we're going to invest some money and then we're going to get some money back, and that might be break even, and it might be a 50% return total over some number of years, but it's certainly not going to be spectacular, and it's certainly not going to make up for all the total losses. But we're going to have a couple of firms in there, a couple of little companies we invest in, where we put in a few $1 million and we take home some big multiple of that at the exit point, so that the returns overall are going to be attractive, but you got to make sure that you're getting into the entire fund and not just 1 or 2 of the investments. So it's a few highly successful investments that are going to drive the returns on the VC fund. Of course, there's no active public capital markets here. That's why we have to have private equity. And then, funding in the future, we're going to have to worry about scalability, those types of things. And what we're going to see is that the costs here are going to be high, so we're going to have carried interest, and there's not going to be the other types of costs that show up. We're going to come back to costs in just a little while. So let's put that off for just a moment. So what about, well, I guess we have some more valuation characteristics here, but now we're looking at the buyout firm rather than the VC. Well, when we move to the buyout environment, the typical scenario would be it's a going private transaction. That is, we have a publicly traded firm and we're going to take it private. Right? So there's going to be some sort of stable and maybe even predictable cash flows. We think it's underperforming. Right? If we don't think it's underperforming, we don't want to touch it. Right? So it's underperforming, therefore it's undervalued. We're going to take it private, get a management team in there where our goals are aligned, bring to bear the expertise that needs to be there to re-engineer the firm, and that's how we're going to create value. Okay? But there is some cash flows going in, right? I mean, they've got a product, they've got production facilities, they've got people, employees, brand name, that sort of type of thing. So established products are already there. They've got a substantial asset base, which of course we can use for collateralization. They're an experienced management team. This is probably referring to the team coming in, right? So that's what the buyout firm is going to do. They're going to bring in a very skilled management team, maybe a turnaround team, which you might want to call them. It's going to be highly levered, okay, with a couple of types of debt, both senior and junior, and risks can be assessed because you have these mature operations, right? So you know what you have going in, and you've got to. It's not like it is easy to do, but you know exactly what has to change. And the typical buyout firm will go in saying, we need to change a couple of things. It's not like they're going to have 47 changes they have to implement. So they've got a few critical things that they need to change, and they're going to be able to analyze those and analyze them fairly carefully and understand the risks going in. So the exit strategy, a little more predictable than what's going on with VC. The exit strategy, goes from parking lot sale to IPO. So we have a little more predictability when we talk about buyout. Reduction in operational inefficiencies. Okay, we could have also written this as an increase in operational efficiency. But anyway, we're going to get rid of a layer of middle management, that type of thing. Working capital funding is going to be minimal, right? So we're not going to have to worry about that. The variability in success is going to be low, so low variability, which means that there's going to be rare total failures, right? We take the firm, come buy a public firm, take it private, and then it ends up being worth $147.32 or something. So we're not going to we don't have quite as great a variability. That's not to say that these are well, they're certainly not sure things, right? This isn't like buying a treasury bill. And of course, fill in your own downgrade joke there. There's going to be active public capital markets, so we can go and issue bonds and those types of things if we need to. It's going to be subsequent funding is going to be easy to obtain as long as the plan is coming together. So we took the firm private. We had 2 or 3 or 4 things that we really needed to change, focus on, underperforming divisions that we needed to liquidate. If those things are going well, we're actually seeing the re-engineering of the firm work, then you're going to be able to go to the capital markets and issue bonds and those types of things. And of course, you're going to have this the carried interest. You'll have transactions costs and monitoring fees in the buyout, but we're going to come back and talk in more detail again about that going forward. So what are the differences? I think this is a great table in terms of summarizing what's going on. When we talk about the buyout firm versus a VC firm, well, if you think of the use of discounted cash flow, well, heck yeah, with a buyout firm, we've got all these cash flows. We can go in there and plug it into our spreadsheet, and we can do something that is meaningful. For a venture capital firm, well, you're just kind of guessing, right? There may never have been any revenues and much less profits or, positive cash flows, so it's just very difficult to use DCF. When you're talking about a buyout, you can use relative valuation because this firm that you're buying has peers. Okay, well, with VC, there are no peers. This is some sort of new technology or something that we're trying to bring to market. What about the use of debt? Okay, well, lots of debt in the buyout world. That's why we call them LBOs, right? Leveraged buyout. So the buyout firm is going to put in a couple of billion, and then they're going to borrow 15 billion or something to make it work. And there's not going to be, this says low debt, more equity. I would say typically there's no debt, at least if you're looking at really early stage firms for the VC world. Okay, in terms of the key drivers here, I think this is accurate for the buyout world. So we're going to say, well, we're going to buy this for $10 a share. And then what's going to happen? Well, so if you think of them as having, earnings equal to $1, and we buy it at a PE ratio equal to 10, then the price that we're going to pay is going to be equal to $10 a share, right? Well, what's going to happen when we take this back and for an exit strategy? Well, we're going to have some EPS growth. So E was $1. Well, we're going to get rid of underperforming divisions, lay off some management. We're going to re-engineer a few things. We're going to do something so that this E, over a period of 5 years, goes to $2, right? So we're also going to have some debt reduction. So the cash we generate in the interim, we're going to pay down debt, so that won't have to be paid back at exit. It'll already be paid off. But this PE expansion is what makes all this work. Remember, what's the primary determinant of PE? Well, there are multiple determinants, obviously, okay, but one of them would be growth. So if you're showing this earnings growth from 1 to 2 over 5 or 7 years, okay, well, growth is going to be high. The reputation of the firm is improving. So private equity, or excuse me, the PE ratio may go to 15, right? So we get multiple expansion, that is expansion of the PE multiple. So when we take this back, we're going to take 2 times 15 is equal to 30, right? So we bought it at 10, and we're going to take it back to the market at 30. Well, that's how we make money in the buyout world. Now, if we look over here on the venture capital side, pre-money valuation, future dilution, that type of stuff, all that is a driver of, all those are important to consider in return when you're calculating returns, but I think that this is more of a way of, well, the future dilution is certainly something you have to consider, but things like pre-money and post-money valuation is more a way of thinking about what is possible than it is actually driving the returns. So the returns are going to be driven by, does this product actually work? Do people want to buy it? Is it scalable? Can we produce it profitably and those types of things? But for the curriculum purposes, we're going to worry about pre-money valuation and dilution and that type of stuff, right? So this is a really good table. If you understand what's going on here, then I think you have a pretty good handle on everything up to this point. And we're 8 slides in, so if you can summarize it with 1 slide, that's pretty good here. Okay, so let's think about the performance from a leveraged buyout point of view. Well, the exit value is going to be, as we just talked about, it's going to be equal to what are we going to sell it for at the end. Okay. Well, all right, we bought it for let's say we bought it for $10. That was our cost per share. Well, there's going to be some earnings growth. That's going to have an increment in value. Multiple expansion, that's going to cause an increment in value. And we're going to reduce debt. So we're going to borrow $15 billion. During our holding period, we may pay that down to $12 billion. So when we bail out, okay, we only have to pay back 12 instead of 15. So all of those are going to essentially increase the exit value and the rewards to being in the LBO firm or an LBO investment. So earnings growth due to operational efficiencies, of course, and then the increase in the price multiple due to growth. So we talked about that previously. And of course, you're going to have to do a lot of scenario analysis here because this is a risky business, and you want to understand what are the critical variables and how do they have to change in order to create a successful exit. So speaking of exits, how do we get out of these things? So for PE, well, again, the thing you're really looking for is an IPO. So if you, what's the story that one of the very early investors in Google, and I forgot his name now. Anyway, I think he put in $3 million and he took home, seems like $1 billion at the IPO. So you're going to get the highest multiples, all those types of things, if you can take the firm public. So this is going to give us the highest exit value. It's the highest liquidity, all those types of things. That's going to be great. It is going to be less flexible in the sense that you have to do it all at once. You have to worry about the conditions of the capital markets, all that type of thing. It's going to be costly because you got to buy some Ferraris for the investment bankers, and an IPO is complex. But if you have strong growth prospects, you have some operating history, you're of the right size, then you can actually, this is, like I said, the holy grail of exits, right? So the next highest valuation would come from a secondary market sale. So you're selling it from one private equity firm to another, perhaps, for strategic reasons. So, but would represent some sort of successful exit. You could have a management buyout. This is where management's going to buy the firm using a lot of leverage. And then you could also have the liquidation, where you're just selling off things in the parking lot, and everyone's going to know. Not only do you fail, but everybody knows you failed, which of course is bad, and that gives us the lowest valuation, probably involving capital losses and that type of thing. So, exit strategy and timing of the exit and all that sort of stuff is what creates a lot of the uncertainty in the valuation of these deals. So, what about details here? Okay, it's important to understand that these are structured generally as limited partnerships. So it's the limited partners that provide the funding. They don't have any active role in management ordinarily. There are times when that gets crossed, but nonetheless, typically they're not going to have any active role in management. They have limited liability, so they put their money in. The most they can lose is 100%. It's the general partner that's liable for all the debts and has unlimited liability. Typically, these things are going to be structured so they have a 10 to 12-year life. And what that means is that your money is tied up for a long time. There may be opportunities to exit prior to that 10 to 12-year horizon, but when you do, it's going to be cumbersome and expensive. Okay, the terms, you have to be a qualified investor, which depending on what country you're in can vary somewhat, but you're going to have something more than $1 million in assets, and you're going to pay management fees of 2%. You're going to have carried interest, which is the general partner's share of the profits. So this is where the 2 and 20 comes from, right? So it's kind of like the definition of a hedge fund, or in this case a private equity deal, is a compensation scheme dressed up like an asset class. Anyway, 2 and 20, 2% of assets, 20% of the profit. So they don't share in the losses, just the profits of the overall fund. And then a ratchet may also change the allocation of equity between the shareholders and the management. But we don't go into this, the operation of the ratchet much in this reading or in the curriculum at all. So I would focus on the carried interest and management fees. So in terms of the other details here, the terms, where there's going to be a hurdle rate. So the hurdle rate is the internal rate of return target that we have to hit before the GP, the general partner, can receive any carried interest. So it's, in other words, maybe a better term for this might be a preferred rate, or not better. Who am I to decide what's better? Okay, a different term that is in line with the way the terms are used elsewhere would be a preferred return. So the limited partners are going to get a 5 or a 7% return, okay, because they're the ones who are out their money, and then after that is met, then the general partner's carried interest would kick in. Target fund size, this is generally a signal of the GP's ability to raise funds. If they say they're going to raise 50 and they can only raise 38, that's a negative signal. Also, just the sheer size of the fund they can raise says something about the reputation. Vintage is actually a really important concept when it comes to talking about private equity, and it may be even more important on the VC side of private equity. But this goes back to the old concept of the J-curve. So if we look at time against the value of the fund, and these things don't fund all at time zero. We'll see an example in a few minutes. But if we started up here at, we were raising $100, well, and we entered all of our, that's when we bought into all the portfolio companies. It takes, a long time, years to build that up and to have the fund fully invested. But nonetheless, what's going to happen is for a while this thing goes down in value because you have, bad happens quickly, good happens slow. That's been the story of my life anyway. So we're going to get some bad outcomes early on, things that are going to, companies that are going to stumble. The learning process always takes longer than you think it's going to take. And then at some point it's going to go up like this. And if you imagine putting a little hat on it like that, it looks like a J, right? So anyway, that's the J curve. And so, maybe this is, year 4 or year 3, somewhere here where it's bottoming out. So what you don't want to do, if you want to evaluate a private equity firm or private equity fund, is you don't want to take a 3-year fund and compare it to a year 7 or year 11 fund, right? Because of this vintage aspect, bad happens quick, good happens slow. So if you want to evaluate your GP relative to everyone else, or a GP relative to his or her peers, well, then what you have to do is line up the vintage of the fund. So how, here's my 3-year-old fund. It's got a vintage. Its vintage is 3. Okay, how do other 3-year funds look in terms of how they've performed? So anyway, something to keep in mind in terms of vintage. Valuation, NAV with frequent adjustments, so that's net asset value, and these are going to be based on model prices, and there's lots of evidence that there's some game playing in that those types of things. But nonetheless, it's going to be the net asset value. So what are the value of the portfolio companies less any debt that they've taken on? And then, of course, due diligence, evaluation of past performance, trends, magnitude of, of the diversification of the pool, those types of things. All that's going to be important as you look at this. Okay, so risks. Well, there's going to be a couple of slides here on risks. So, liquidity risk. Well, once you get into these things, they're hard to get out of. Competitive environment. Well, okay, so this refers to both the competitive environment that the portfolio company is operating in, but also we used to have a big private equity conference at my university, BYU, and I remember the lament of the PE people was, well, there's so many PE firms now, it's hard to find good deals. So just fewer deals that you can get into at, a low cost, and we sure feel sorry for them when they're driving off in their Ferraris. But anyway, so the competitive environment, both of the portfolio company and of the market that we're talking about, that is the PE, PE's got to compete for the deals just like any other competitive environment. So there's agency risk, principal-agent disagreement here. You think, well, here's the genius scientist that's bringing out the optical computer or whatever it happens to be, and how well aligned is his interest with the interest of the fund, okay? Or between the GP and the LP, there can be conflicts there. Capital risk, somebody needs to withdraw capital or court-ordered withdrawal or some sort of litigation. Regulatory risk, of course, the government changes regulation. This is frequently these are sort of disruptive technologies, so the environment that they're working in, the regulatory environment may also be developing. Okay, tax risk, so what about the returns to private equity? Are there going to be changes in the way that's taxed in terms of capital gains and when you recognize the gain, that type of stuff. Valuation risk, this is one that I think is particularly key for thinking about the process, and that is, look, we're calculating NAV, but we get that NAV for 12 portfolio companies based on all these model values. Well, if you have models, you have to have inputs. If you have to have inputs, you have to have people, and if you have people, you have mistakes and maybe bias. So there can be valuation risk associated with this process. Diversification risk, you're not going to be able to own 100 different companies, so you're going to be poorly diversified, at least if that is a primary portion of your portfolio. Of course, what's supposed to happen is you're supposed to have a little bit of your portfolio here and then a lot of it somewhere else. But nonetheless, if you're looking at that fund, it's going to be poorly diversified. And then you're also going to have market risk, right? So what's going to happen to interest rates, the economic environment, all that sort of stuff is certainly going to impact the timing of the exit and also the viability potentially of the products. So cost of private equity investing, transactions cost. So you got all the due diligence, the cost of doing that, bank financing, legal fees, all those types of things from setting up the fund, which I guess would go into this idea of fund setup cost. I would lump those two things together. Administrative costs, you have to have a custodian, transfer agent, you got to have accounting. You got to have an accounting department, and then depending on what you're doing, who you're doing it for, there's going to be perhaps audit fees. So those all have to be dealt with. Dilution costs, if you're going to provide equity financing today, well, typically this occurs in multiple rounds, and I've always thought this was one of the things that private equity people understand that entrepreneurs don't, and that is, well, okay, we need $3 million today, but we don't know it yet, but we're going to need another $2 million in 4 years, right? So the entrepreneurs are by nature optimistic. So when we go and issue raise some more funds, well, we're going to have to give somebody a portion of the company, and that's going to be something that we need to take account of going forward. And then also placement fees. So if we want to put $100 into a private equity fund, we may have a placement agent that's going to take 2 of that. And so all of what I've talked about and all the setup costs and transactions and dilution and placement, all that sort of stuff, that makes it an expensive investment. But then when you add this, which is the cost that we focus on in the curriculum, that's the 2 and 20, okay, 2% of assets regardless of what the value is, and then 20% of the profit, maybe profit above some hurdle or preferred return. But nonetheless, if I look out into the world and I say, who is it that can perform well? I'm a big fan of private equity. If I wasn't in such a cushy job in academia, I would want to work at a private equity firm, right? Because I think they perform well, it's exciting, all that sort of stuff, or have the potential to perform well, but they darn sure better perform well, right? I mean, so you got all these other costs, plus you got this 2 and 20 thing. So for the LP, for the limited partners, the performance is going to have to be really good to overcome some of these issues. Okay, so what about financial performance, and how do we present that? Okay? So what we're going to do is the since inception internal rate of return. And this is what is specified in GIPS. So if you think back to when you were studying GIPS, then it talked about there was one section for private equity stuff. Well, there's a lot of stuff in there, but since inception IRR is going to be the I guess mainstay for how we determine return. So that's going to make it a money-weighted return because it is an IRR. It assumes that immediate cash flows are reinvested at the internal rate of return. But PE fund investment tends to be illiquid, so we can't really take those intermediate cash flows and reinvest them. So that's going to, our reinvestment return is effectively going to be 0, which is going to make the actual returns going to be lower. We've got to worry about whether this is gross or net of fees. Of course, when I'm emperor, it's all going to be reported net of fees. And then also we've got to think through time value of money issues, which will be included if we do it in an IRR framework. Okay, but there's also another framework where we won't see the internal rate of return. So we won't see the internal rate of return, so it won't have a time component to it. In particular, here is a different way to do this, and I think it's actually probably more popular, and this is the way I see it presented most often, and that's to do it in terms of multiples. It's simple, it's easy to use, and it differentiates between realized returns and unrealized returns. So the IRR doesn't do that. It gives us a time function, but it doesn't differentiate between realized and unrealized. And this is also part of GIPS. So here's what we have. We have paid-in capital, and that's the percent of capital used by the GP. So the way this works is if you're an LP, you commit some money, and you don't write a check at that point in time. Did I say LP? If you're an LP, you commit some money, but you don't write a check. The GP runs around, gets all the commitments, and let's just say gets $100 in commitments. Then they go out and they start looking for portfolio companies. Well, when they find the first one, they need $10. That's 10% of the total. Then they'll have a cash call, right? And that means that everyone will have to send in 10% of what they had pledged, and that'll start the ball rolling. So the paid-in capital is the percent of the total fund size that has been actually called down. That's the definition. That's what it is, and that's right. But to understand these next 3 bullet points, just think of this as being $1, okay, or 100%. All right, so it's $1. So then, after we get past PIC, that is paid-in capital, we can talk about DPI, that is what's been distributed to PI. Okay, and if that equals something like, 0.4, then what that says is you've gotten 40 cents back for every dollar that was actually committed. All right, so this is a cash-on-cash return, so you got, $0.4 back, and you invested $1. Well, that's where the 0.4 comes from. So that is a realized return. For every dollar you put in, you receive 40 cents back. But remember, we have these 10 portfolio companies, and then we have an exit. Some of them are terrible exits, some of them are wonderful exits, but we start distributing money, right? But while we're measuring this is what's actually been distributed. There's still companies that have not yet been exited, not liquidated. So that's the RV, or residual value PI. If that's equal to 1.2, that says 1.2 over 1. So if I look at this, I see my DPI as being 0.4 here, and my RVPI as being 1.2. What that says is over the time period that I've been invested in this fund, right? So it goes from time 0 to whatever today is in terms of vintage. Then I've got 1.2 plus 0.4 is equal to 1.6. That is the return per dollar of investment. So for every dollar I put in, I've gotten $1.60 back, and that's what we call the TVPI. Right? So the total value that's been created. But remember, the 40 cents here is realized. So we know what's going on there. This $1.20 in my little example is based on model values, because we haven't liquidated those companies yet, right? So anyway, so this is a financial performance based on multiples. This is actually the one I think you want to focus on. I mean, you ought to know what since inception IRR is as well, but I think you'll see this one being more robust, and it's integrated more into the rest of the curriculum. All right, calculations from a private equity fund. So this is actually a pretty long example, so I want to go through just a couple of lines, but you'll see that down here we've left some blanks, right? So we can sort of talk about what each of these columns are. And then we can think, well, at the end of 2014, we have the data. What would be in here for 2015 is basically what we want to do with this particular example. So here we have the GP of PE fund charges a management fee of 2%, carried interest of 20%, which is paid after the portfolio value of the company's portfolio value exceeds the committed capital of 140. All right, so when we get to where they've been over this 140, then we're going to have this committed. We'll have the 20%. Let's see. So we want to calculate for 2015. Okay, the management fees, the carried interest, the NAV, that is net asset value, both before and after distributions. And then let's do our multiples: DPI, RVPI, TPI, assuming this following information here. All right. So we look at the capital called down. So you can see that in the first year we started with a capital call of 45. So the paid-in capital is 45 because that was the first year. The next year we call in another 15. So now we're up to 60. Right. When you have 45,000 or 45, I guess it's probably 45 million, right? 45 million in paid-in capital. Well, the GP is going to get 2% of whatever's been called down. So we take 45, multiply it by 2%. That gives us 0.09. So 900,000 is what they're going to get that year. And then the operating results. The operating results here are a minus 10. So we put in 45, and it immediately increases to where the value of our portfolio companies is 35. So that's the J curve, right? So net asset value before any distributions. We started out with 45. We lost 10. And we had to distribute 900,000 because the GP has to eat during the life of the fund, right? So we're down to 34.1. There is no carried interest because we haven't got to where we're up above what has been contributed. And then no distributions to the LPs because we haven't made any money yet. And so that gives us an NAV after distributions of 34.1 as well, all right? Well, let's jump down to 2013. So in 2013, we called down 15 million. That brings us up to 85. So management fees, 2% of that is 1.7 million. Then the operating results this year, it's a good year. So the value of the portfolio companies, we go up by $50 million. So the NAV before distributions is 34.8. So it's going to be the NAV after distributions from last year. Then we're going to add in the operating performance, subtract out the management fees, and add back in the capital call down in order to get our NAV before distributions. Okay, well, now we've got to pay any carried interest. We're still not doing that. And distributions, we're still not doing any of that. And that leaves us with 134.8. Okay, everybody okay with that so far? All right, so here's what I want to do then. I want to look at the change from 14 to 15. All right, so let's fill in these numbers and see what we can come up with. So notice that we called down another 5. Right, so this is going to bring us up to 100. So we started with 95. You can see that as the paid-in capital in 2014. Goes up 2015, we get 5. So this is going to go to be 100. If I can make my pen right here, that's easy enough. Okay, so what are my management fees? Well, if I've got $100 under management, 2% fees, well, that's going to be 2. Right? Then my operating results were a strong 90, right? So what's going to be the NAV before distributions? Well, it's going to be the NAV after distributions from last year, which are 170, plus 90, right? Then minus 2 and plus 5. That makes sense? So we brought in 5 more. So we had 170.3. We brought in 5. We had to pay out 2 to the GP, and the operating results go to where we increased by a value of 90. So that gives me 263. 0.3 as it turns out. Okay, what about carried interest? Okay, well, now the value of the fund is above 140, right? So now I'm going to pay carried interest. But remember, if I look back to last year, what this number is 202.9. 202. I'm going to start that over. 202.9. Well, I paid carried interest on the increase in value above 140 last year, right? So when I look back to last year, it crossed the threshold from 140, which was what we were looking at up here, right, up to 202.9, and I took 20% of that. That's that 12.6 here. So if I take 263.3 and I multiply it by 0.2, then I'm giving them 20% of the whole 263,000, right, 263 million. And not only that, but I can't take 263, if I subtract it off 140, then I would be paying them 20% of whatever that is, right? So 120 million. But I've already paid them for taking me from 140 up to 202. So the carried interest is simply going to be the NAV before distributions. So this is wrong and this is wrong. It's going to be 263.3 minus the NAV before distributions last year, which was 202.9. So I'm going to take that amount. That's the increase in the value of the fund. Well, they're going to get 20%. When I say they, I mean the GP. They're going to get 20% of that. And if we come over here, we can see it. That's going to be 12.1. So 12.1 is what we'd plug in here. All right, a lot of red on this slide. I apologize. And then what's the NAV after distributions? Well, we're assuming that we've liquidated some investments this year. We paid out 50 million. So here's my NAV before distributions, 263. Okay, I'll just see it on the next slide. 263. I had to pay 12.1 in carried interest to my GP, and then I had 50 million in distributions to my LPs, which gives me an NAV after distributions of 201.2 for this year 2015. All right, so that's how we would calculate all these different metrics. So paid-in capital, the management fee, carried interest, NAV before and after distribution. And I'm not sure that this is hugely important, but you probably ought to be able to think through an example in your mind and know what comes out and when. What about our multiples here? So if we look at this and we assume that these are our distributions, okay, so we've just, at the end of 2015, we've distributed a total of 70. Okay, and if we look at the NAV after distributions, okay, so here's the NAV after distributions. So what this says is at the end of 2015, I had paid out, I paid out 50 million, which gives me a total payout to date of 70. but the value of the companies that are still in the portfolio at that point in time are 201.2. Right? And that's all the model values, and we can talk about gameplay and on that. They just don't talk about it much in the curriculum. Well, what did I pay in? Okay, so here the paid-in capital totaled to be 100. Right? So my DPI, I've paid out 70, so there's 70 million that's been paid out on 100 million total that was paid in, the total paid-in capital. So that tells me it's 0.7. The X just means per dollar, so I've received $0.7 back for every dollar that I put in if I'm a limited partner. Okay, the RVPI says, okay, well, there's still 201 million, we hope. I shouldn't say that. That's the model values, right? We'll assume everybody's good and honest. 202.1 divided by 100, that says that I still have $2 coming. So this is my realized return, 70 cents on the dollar. This is my unrealized return, $2 on the dollar. And if I add those two things together, what I see is that so far, and this doesn't have a time component, it could have been 47 years, exaggeration, but it says that we were going to get $2.70 back to date for every dollar that we put in. Now, one of these portfolio companies may still, hit it big, and that 201 may go to, 401 or something. But to date, if we want to compare against other vintage funds, our TVPI, that's probably a number that we want to compare across funds of the same vintage, because that gives us both the realized and the unrealized return. So that's the calculations for the private equity fund, and I think being on top of where those come from is reasonably important for the exam. Okay? Now, there are an assigned appendix. It isn't like we're going off on some tangent here. There's appendix with learning outcome statements. So let's talk a little bit about venture capital and funding rounds. And you could do this with multiple round funding, right? We're just going to look at an example with one round. But the point is this. Look, we're going to start at time 0, and we're going to have some exit time. So we think in some number of years, I'm going to call it 5 years, we think that there is an exit value up here. So I'm just going to put a dollar sign. Well, if you'll remember this one thing, I think this will be a whole lot easier. So what we're going to do is we're going to find, pre-money valuation, post-money valuation. We're going to talk about equity division, in terms of who gets how many shares and all that sort of stuff. But if this is single round financing, if you'll do the money going backwards, so I'm going to say, okay, I've got some 5 years here. If you discount back this way, and then you do equity going this way, then this will be relatively easy. All right? So in this case, it's a single round, so going forward, this doesn't look too complicated, but it gets a little more complicated if you do multiple rounds. And I would look at an example using multiple rounds before I got into the exam. So the firm's entrepreneurs believe they can sell the firm for $60 million in 5 years. So that's what we think this number over here is. We think it's equal to $60 million. All right? The initial investment of $7 million, that's what they need today in order to bring their production processes, finish their research development, whatever it is. Okay, they need $7 million today. So they want to hold 1 million shares, and this, of course, I think is kind of hokey, just because you want to hold 1 million shares, fine. You want to hold 1 billion shares, well, fine. Take 1 billion shares, and I'm just going to take, I'll take 20 billion shares, right? So it's just an accounting entry, but nonetheless, the equity division is something that leads into this. So the discount rate is 40%. That's not atypical for a PE firm. They're going to discount things at 40%, but remember, they got a big hazard rate that they are using to get into that, because there's a high failure rate among these small firms. So we want to calculate pre and post money valuation, ownership fraction, and price per share for each of this little example. All right. So let's go in and have a quick look. So if we think that the firm's going to be worth $60 million in 5 years, and this is the hard thing, right? So how's it going to be worth $60 million? Well, you got to think in terms of market space, market share, price, margin, all those types of things. So this may be the most assumption-dependent number you will ever see in finance, right? So we got somebody's garage, they got a box that they're working on, and we're going to say it's going to be worth $60 million in 5 years. Although like I say, work with a little company that I know we've never turned a profit, and we're going to get bought at like $40 million. So anyway, I only own this much of it. So anyway, for me, it's going to be like a $12 payoff. But anyway, so, I guess this stuff does happen, right? Anyway, so $60 million is the end value. Well, this is the exit value of the entire firm. So 100% of the firm we're going to sell, and it's going to be worth $60 million. What does that have to be worth today? Well, if we discount that back for 5 years at 40%, then that says that the company as it sits here today, okay, so it's got to be worth, I'm just going to put 11 million, all right? So you're going to put your money in, and then the firm is going to be worth $11 million today. And if you think, oh, there's no way that's worth $11 million, then you probably don't want to do it, right? So that's the post-money valuation. Okay, what about the pre-money valuation? Well, the pre-money valuation is just the post, which we said is 11.1 million, and then you take your money out, and that gives you 4.156 million. So the point here is, we're standing here at time zero. You have a company that on its own, as it sits there, just the idea, unfunded, should be worth 4.1 million, and after you put your money in, it better be worth 11.1 million at least, or else even if everything goes as you anticipate, okay, you're not going to be able to get your 40% return here, right? So the pre and post money valuation, start with the end value, discount it back to the beginning, okay, the beginning of the financing round. That's the post money. That's after you put your money in, okay? Then subtract out the investment. That gives you the pre-money. Is not that big a deal. So what about the investment percentage? Well, the investment here, I'm going to put $7 million in. If I'm going to put $7 million in and the company is then going to be worth $11 million, I'm contributing 7 of the total of 11. Right? Well, then that's 62.75%. So that is the share of the company that the PE firm is going to want, right? The VC fund is going to want because, it's worth a total of 11. Okay, they're getting 7, so 62.75%. Well, if, we go into business, I contribute $7, you contribute $4.15. Well, I've contributed 62.75, you've contributed 4.15. Well, that means we're going to divide it 62.575 and whatever the complement of that is, right? So, the VC fund is going to take 62.75% of the equity. Okay, what about the shares for the PE fund, right? So this is the shares that are going to be held by the entrepreneurs. That's what the little e means. So if we take this F, that's the portion of the equity we need to own, over 1 minus F. Okay, that's 60.62 over 1 minus 0.62. Multiply that by the 1 million shares. That says that the PE fund is going to take 1.684 million shares, and the entrepreneurs are going to keep 1 million shares, and that's going to be 62.75%. And what is that, 37.25? Did I do that right? Anyway, so whatever the complement is, so they're going to have 1.6 million or 1.7 million and 1 million shares. And what you can do with that, if you are on the well, it doesn't matter which side you're on. That means the price per share at this point is going to be, well, I take the $7 million that I invested as a PE fund, and I take the 1.68 million shares that I get for my $7 million, and that tells me that the value per share is going to be $4.16. So what good is that? The only thing that number is really good for is that if you have an IPO in 5 or 6 years and you go IPO at a split adjusted rate of 78, well then you can, when you're at cocktail parties, you can say, yeah, we bought in around 416 and went public at 78, right? So anyway, so that's the price per share, and it's great for bragging at cocktail parties. Okay, so adjustment for risk in venture capital investments. So this is using this idea of a hazard rate. It's not really a hazard rate, but something like it. So assumes that the private equity investors have a true discount rate of 25%, but the probability of failure in any given year is 20%, right? So every year there's a 20% chance that the investment is going to fail, and really it's going to fail completely. It's going to go from whatever it was to 0. Well, if you want to know the return that you have to use to get to earn your 25%, given that you have this 20% failure rate, so in expectation, what do I have to earn, given that I think I can go to 0 in any year? Well, if I take 1 plus my required return, 1.25, over 1 minus my annual probability of failure, okay, so 1.25 over 0.8, subtract off 1, then I find that my discount rate needs to be 56.25%. So anyway, and this makes for, I'd throw this formula on my formula sheet just to, it's easy, and it makes for a good question about, rates of return and probability of failure and why private equity has such high returns and those types of things. All right? So what are the keys here? Sources of value creation. That was, when we talked about earnings growth, multiple growth, that type of thing. Characteristics of VC versus buyout firms. I think that's something that you want to know something about. Risk cost terms. Okay, so those are definitional, but I would spend a little bit of time on that. I would certainly spend some time being able to work with my multiples. Okay, and then the calculations for the VC firms, I think would also be, which is what we just did, all the pre and post money valuation stuff. I think those would also be useful because they're easy to write questions on, and private equity is sexy enough that it's, given that writing questions is a terrible chore, it's probably more fun to write questions about private equity than it is about real estate or something. So anyway, I would make sure and have a handle on these terminologies and these basic calculations.